45,500 options contracts. What do they mean for TSM, Taiwan Semiconductor? These were done at 10:51 a.m. today, May 16. It is now 12:02 p.m. In this video, we're going to analyze these options, including this 38,456, all done at about the same time, 1 second apart, as you can see here. 10:51 a.m. One was done at the 14-second mark. The other one was the 15-second mark. And so what does this mean for TSM? Is this bullish or bearish? As usual, in this video, we're going to go over these unusual options and determine is this bullish or bearish, and show you how we are going to be trading Taiwan Semiconductor. So without further ado, let's get right to it. First up is the May. Let's take a look at the May 19 expiration. These are going to expire just this week. This is the 70 strike calls. So when we look at the May 19s, 3 days away, expire, we see the 70 strike calls right here. You'll see the volume here, 38,457 of them, just a little bit below the open interest of 38,613. The open interest here, and the volume is here, right? So this is the column for all that. So what we believe is happening here is that these orders today are closing orders. They are closing this order because these were opening prior. And by closing these orders, they are essentially rolling it out to a further date, to this August 18th date. That's 94 days away. And there you have it. Those 45,500 of them are here. There was no open interest so far at the 75 strike. Now it shows 46,000, right? But that could be other people just buying into it because we saw their order was a total of 45,000, right? Or it could be even the same institution that just bought this. You see here, just about 2 minutes ago, at 10:53, another 1,000 orders came in for this trade. So whether or not it is that institution or not, we definitely know one large institution put in this order, which was, you'll see the price here, $13.55, which is, if you have to multiply that by 100 to get the total dollar amount, which is $1,355 per contract, since it is we are trading options, so you have to multiply by 100. And so the quantity now, you multiply that by 45,500, and you'll see that this was a $61.6 million trade. So definitely very large institution that did this trade. So what does that mean? Well, it basically means that this order, since they rolled this, they closed this up, now they're left with just this order. And so just this order is right here. What they did was they bought this 75 strike calls. It is a delta of 82. So they get 82 deltas for every contract they buy. And they're purchasing it for about, currently it's going for $13.85, but we saw that they purchased it for about $13.55. So essentially, instead of buying 100 shares or 82 shares, since it's a delta of 82, If you multiply 82 shares of TSM, which is going for, you see $86, this would cost about $7,000 to get the 82 deltas. But what they can do is they can just pay this less price, $1,300. And so you'll see here when we analyze this and we look at the Greeks, you see that the delta is also that close to that 82, 81.5, basically 82 deltas they're getting for just paying that amount, right? So originally they paid, I believe they paid, again, $13.55, right? Here it is, $13.55. Here it is again. So essentially, this would be the shares if you bought 82 shares of TSM, 7,000. So let's just kind of estimate. So 13.55 divided by that 7,000, they're paying only basically, see at 19.19, that times, that's 19%, right? So they're only paying just 19% of what they would have done if they bought shares to get 82 deltas. So they're getting a discount in the deltas. So what they wanted was they wanted this 82 deltas, but they didn't want to pay 7,000. They just wanted to pay that 13.50, which gives them that discount. Basically, it's close to an 80% discount, because if you do the math, 1,300 as we just did is only about out of that 7,000 is only about 19%, meaning they saved that 80%. It's close to 80%. They're trying. They basically didn't have to pay 80% to get these 82 deltas. So that's the strategy that they're using here. And this is why this type of strategy, when you're buying the 82 deltas, is called a stock replacement strategy. This is when you're bullish on a stock. Instead of owning it, you want that leverage from owning options. And so this is a way you can reduce your cost of just paying $1,300 instead of $7,000. So this is the advantage. And this is telling us that TSM is bullish, at least for this 94 days until August 18. Otherwise, they wouldn't have rolled their contracts out and stayed in this position where this amount of volume is such a large volume that it's definitely bullish. And so what we did for this trade, because they're bullish, what we did was we bought the 95 strike calls over here. And then what we did was, because there's a theta decay on this, you'll see the theta decay even on this contract here, this unusual options, what they purchased here, there is a -2 theta decay. And so we didn't particularly want a theta decay of that amount. We didn't want to lose the value of our options as time goes on. And so what we did was we went to a closer date on the June 16th. It expires in 31 days. And we sold the 95 strikes. So by selling that, we created a calendar spread. And so when you analyze this trade, take that one off. So this is our trade. You'll see this is also a bullish trade because it will gain as it goes up in price. The purple line is the current date here, and the blue line is the expiration date of June 16. And so as the price goes up, it's currently at $86. As it goes up on the x-axis here, it will be gaining because this will be above that zero profit loss on the y-axis. Anything above this is profitable, anything below is a loss. So these are all going to be above. The disadvantage about the calendar spread is that if it rallies too much, it goes too much. Like here's our break even at expiration. If it goes past about 104 or currently, well, expiration would be 104, right? Here's our break even. If it rallies too much, it would start to incur a loss. However, by that time, if we start getting closer there, we would probably close our trade by then if it's starting to head this way. The reason why we think this calendar spread is advantageous, though, and we're willing to take this risk on the upside, is because when we look at the Greeks, you'll see also we have this very high Vega trade, and we have this minimal theta. You'll see, as you remember, there was a -2 theta on the unusual option trade, but now we've minimized our theta decay with this trade. And at the same time, we get a very positive Vega. Why do we want a positive Vega? Well, if we look at the current IV percentile, you'll see here current IV percentile, which is the current implied volatility, is 1% at TSM right now. Its implied volatility is at 32%, but its percentile, how it ranks, means that it is very low currently. So we think that because it's such a low IV percentile, there's a lot more room for this to increase in volatility and Vega. And so we want a Vega to take advantage of that potential increase in IV. So that's why we want a positive, as much of a positive Vega trade as we can. This unusual option trade also has that Vega here, 11 also, but we're able to also capture it with our trade at 10 Vega. But we also have a favorable theta, as we showed earlier, that ours is very close to 0. And the other advantage is that instead of paying 1,300 for this trade, we are only paying 175 per contract. Just that's it. So we can adjust how many contracts we want to decide how much Vega we want, or how much deltas we want too. So that's the advantage of this, is that we can break this trade up into smaller bits and also have a positive outcome with the Greeks that we want. Okay, so as we look at the chart on TSM, you'll see here it has gone up, but then it came back down. Up beginning of the year, it was over here, went up, came down, and so now we're here. And so based on these unusual options, at the 75 strike price, which is about right here between 70 and 80, right? They don't believe it's going to come back down where we started from the year. I think the large institutions are having a positive outlook on TSM. There is no more, as you can see, there is no more earnings risk. We have already passed earnings. Looks like it had dropped for earnings, and now it looks like it is rebounding and recovering from this earnings drop. And so that could be one of the reasons why they are still bullish on TSM. Okay, so as usual, please smash that like button. It helps our channel grow so we can share more information and insights whenever we see unusual options. And make sure to subscribe and hit the bell icon so you'll be updated whenever we see unusual options. Comment below also on what you think about TSM. Do you think this is going to be bullish? Is this going to go up from here? Do you think these unusual options are accurate? Are they going to go? Is this going to go up? We have until about August. Is this going to be going up? Will it ever drop below 75, do you think? which is that strike price where they got it at. Okay? All right. Well, take care, everybody, and good luck